And welcome to another episode of Let's Talk Stocks, episode number 115. And in this week's episode, I want to share with you about how the stock market plays tricks on you during the holidays, or more or less, especially during the December months. So that's what I'm going to cover here as we approach and we get into December and shortened holidays and trading with lighter days. I'm going to share with you how this market can really play some tricks on you. Now, before we get started, keep in mind all these examples are for just educational purposes and illustrative purposes. They're not recommendations to buy or sell any stock or security. I think by now you guys should understand that. But just to be clear, remember, these are just for educational purposes. Now, before we get into our examples and our lessons and talking and looking at some of the stocks, I do have some news and announcements real quickly to share with you. Basically, the first main thing is live classes and schedules are posted. So what I've done actually for this next year coming up, if you go to the TRADERSFLY website, and then when you're here, you can take a look at the live classes button right at the top. So that'll be right here. So this button, if you click that button right there, I've created kind of a mini schedule. These are just tentative classes and events that I'll be doing, including some of the critical charts, just some of the places where I'm looking to post some charts. These, of course, may change just depending on market conditions. If market conditions accelerate, meaning there's more activity, then maybe I'll add a few extra sessions. But also I've scheduled some webinars right here. So we'll be doing more webinars and video classes that I'll be getting into here shortly. Now, for the time being, you can register for these even if you have a regular membership. But since we'll be going more into video-based memberships here shortly, which I will explain in a second, we'll be having and creating a secondary membership. And that's just simply because the cost to run webinars and the cost to run these sessions is much more expensive. Now, what I'm looking to do is also have some free upcoming live classes for newsletter subscribers. So if you are not on the newsletter list, make sure to get on it so that way you can see where to register for these events. It would be free, of course, for these newsletter subscriber events, but you need to be on the newsletter list. And that is, again, because the software that we are using it costs money. It costs additional money, so we're limited to 50 seats. We can buy more seats as we need to, but for the time being, so when we have these free webinars, for example, getting started with trading Q&As, you can see the newsletter for registration. So check the newsletter for the links. I'm going to have an updated calendar there in the newsletter as well, where you can just click the link and get into the registration. And we have two of those scheduled, one in January and one in February. I might try to do that once a month for newsletter members. So it's just another little benefit to being on the newsletter and checking in on that. So in either case, those are a couple of the quick notes for these memberships and for these live classes. So check into those, and we'll be doing even more things here as these wrap up. Probably around March time, we might even get into live trading. Where I share with you how to trade if you're retired, how to be more successful in those, and we might do like a 6-week class where twice a week we go through the trade step by step. So that's what's coming up in the future. Now, the new packages for the critical charts, I'm going to start them out at right around $35 at a discount. So that'll be a little bit of a promotion for a few weeks that we will run, and then the price will increase because I know some people are on the old legacy plans. And I won't mention how cheap those are, but everybody's on different plans simply because if you've been with me for years, I haven't changed the plans. And you can still stay on those plans if you wish. There's nothing wrong with that. It's just you won't be getting as much of the video content that goes along with the new charting videos that we will be releasing on a consistent basis. So those plans will be released coming up in the next week, and you'll be able to get access to those plans and sign up for that plan. And then after the 2-3 week period of the specials that we'll do, it'll be a little bit higher price than $35 a month. And that'll just be the standard pricing after that. So in either case, if you sign up to it early, then by all means, you'll get locked in at that rate for pretty much forever. So anyways, the next thing is the Accelerate Your Stock Market Education course. I've reworked that course completely from the ground up. I mean, the concepts are similar, but I took it from scratch and reworked a lot of the material to go more in detail. So this course is also, if you're interested in this course, I would recommend you go ahead and get on the Rise to Learn website and buy it, because if you have the old copy or the old version of this course, you will get access to the new version absolutely free. So we still need to wrap up this sales page right here in the descriptions, but it's going to be, as you can see, the runtime here. We have a foundation module that's about 45 minutes, 38 minutes, 50 minutes, 65 minutes, 66 minutes, 32 minutes, 28 minutes for module 7, and 60 minutes for a bonus module right here. So you're looking at about 6 to 8 hours of material here if you calculate it, compared to version 1.0 of this course, which is basically about an hour or so in length. So if you get the old version right now, which is the only one actually available, you will get access to this one, which will be coming out here in the next 2 weeks as well, once we wrap up the sales page right here, which you can see, and we just tweak it a little bit and finalize and button up some things. So get that. If you're interested in this course at all, I highly recommend it, because the price right now, it's much cheaper, and it's also you're going to get both courses, whereas in the future you're only going to get access to the new one. So that's just one of those things that I do for legacy members or older members. I just continue to add and pile in all the additional material absolutely free. So again, if you have access to this course already, you're going to get the new course for free, absolutely free. It'll just be right in your account once that's released, which will be coming out here in the next 2, probably 3 weeks, simply because the holidays are a little bit more busy. So anyways, let's get into episode number 115, how the market plays tricks on you during the holidays. And this is what I really want to cover today in the lesson. So let's briefly just take a look at the market here, at how it's doing. If you look at the Dow Jones, they keep talking about this Dow Jones 20,000. In reality, for regular traders or investors, if you're active, you really don't care about the number 20,000, 15,000. It doesn't really matter. What you're looking at is the expansion of the move. So here, as I look at it, I'm seeing the move, the expansion of this move is pretty steep, and that's kind of the thing that concerns me. Now, the other factor of it is that we do have major volume that came in, so that's a really positive sign. However, the expansion is still quite large. So right now, obviously, I'm bullish, looking to the upside, but I do look for a pullback. So when other people are euphoric, you want to be the one taking profits, because things don't go up forever. You know that in the stock market. If you've even been around for more than 3 months, things don't go up forever, and these are not normal conditions. This last month, a lot of beginners think they're geniuses, and you'll see eventually there will be a pullback. It's just a question of when. So be humble on what's going on and what's happening. And in the months of December, this is why I want to go in detail about this. In December here especially, the market will play tricks on you, because we have shortened trading time. With the holidays, there's less days that are traded, the liquidity is less. So all those things play a role and a factor, and there's a reason for that, because you have to remember that when we start looking at the market here, people are looking at their taxes, that if they can hold out a little bit further, it's all about that taxes. And if you're a big trader, big investor for a large corporation, you're doing a lot of money management, the taxes between short-term capital gains tax and long-term capital gains tax is huge and dramatic to your profit. So I'm going to share with you some insight here, but let's briefly just take a look at the market. So here, as we look at the Dow Jones, you can see this one right here broke out in a big way from that 18,600 level, and we powered and rocketed higher. If, they did some breakdowns here of when it broke the 10,000 mark, and you can see what happened. As we broke the 10,000 right around this level, we then got under it, retested it, rejected it, got down all the way over here to about 7,500, then broke out again above it right here, above the 10,000, and then again sold off. So even if you break out of that level, you can see that between this point and this point, you had some serious sell-offs as you start looking at things. So even there, here's your sell-off right here, and then here's your other sell-off. Now this one we had more expansion on this side, but the sell-off came pretty big because remember, now the shorts are piling in. So the same thing here, we might get this expansion move, and then you could get a nice little pullback as well. So we'll see if that plays out. For now, things will be stable simply because they're waiting for this month to kind of close out. But we'll see what happens here in January after the inauguration and things like that as things continue to evolve and develop. The S&P, same kind of concept right here. If you look at the daily, we're starting to get some sideways consolidation. This is actually really healthy for the market to be able to move higher. You need sideways action or you need a pullback. So here we're getting some sideways action right here. If we get a little pullback, I wouldn't hesitate to buy more simply because the market has shown you it's moving to the upside. So I'm looking for value buys to buy more to get more expansion to the upside. Now, if there's heavy selling that just comes in, like you see a massive down bar 2-3 days after days like this one, then on the other hand, I might be a little more cautious and I might actually put on a few shorts or hedging positions. But if it's just normal bars that are kind of pulling back, something like this, it's slow every day, you just see some selling, but it's slow. In that case, it's a value buy rather than panic selling. Whereas when you see things like this over here, that's more panic selling. Okay, but if you see something light like this, that's just normal profit taking, caution, pullbacks, it's a little more standard. So keep that in mind. You're looking at the speed of the action as well. So for now, we're just moving sideways. I would expect this to maybe sell off a little bit in January. Now, we'll see if that plays out only because, again, we're so far extended. The reason I'm saying this is we're just so far extended. But if we get more sideways movement like this, and we just continue moving sideways for another couple weeks, then I could definitely see it moving higher. It all comes down to how much energy we can build. Now, looking at a few quick stocks, if we look at Apple right here on the long term, right here, you can see rejection. And I'm looking at Apple because I'm looking at the leaders, right? The stocks that normally lead, the people that love these stocks, because these are the ones most people are piling into. And that's why I'm watching the leaders. So, these leaders are now changing. They're changing into other companies. But really, do you think that a steel company is going to really lead the U.S. economy? More than likely, probably not. I mean, the people that are looking to get their jobs back in the manufacturing, some may get some jobs back, but most of them are not going to get their jobs back, unfortunately. That's just where we're heading in the global economy. We're in a global economy, and China and other countries are producing things at a cheaper cost. An American worker is not going to make T-shirts like they do in Bangladesh, for $2 an hour, $4 an hour. They're not going to do that in the U.S. You just can't afford it due to the standard of living. So you have to start looking at these things, at how they're playing out. So here, the same thing. The banks running up due to deregulation, they're saying, which is fine. It's possible. Bank of America could go a bit higher. I would still say 25 is fine if it gets to about $25, $30. But after that, once it hits around the $30 level, I would say it's way extended because you're trading now based on the earnings, the valuations, you're trading in 2018 earnings, 2019. You're so far extended that the earnings have to support that, which as we get earnings in JAJO months, meaning January, right there as we come up, as we get into the January month right here with earnings, you're going to see how things play out. The first earnings quarter is probably, you won't see a lot of things because right now they're trading based on hype, right? They're trading based on deregulation and things. But as you get into JAJO, April, right? J for January, A for April, O for October. JAJO that's just the way I remember it. And June, July there as well for earnings. As you get into those months right there, you're going to have to see the second and third quarter earnings start to support that with the new administration. And that's where I see could have some trouble. So January in these bank stocks, you might not see any trouble. So when you look at things like that, or a Capital Financial right here, we're getting into some, this is the monthly chart. You can see we're cutting into some major resistance levels. And that run up is just quite high for what it should be. It's not to say that it can't go higher. It's just saying what's real, what's realistic. Can a person really jump off the ground 20 feet? There's some people that can jump off pretty high, but how high is too high? So that's the thing. For me, these kinds of things, a little extended, so I don't chase these things. And that's what keeps me saying, I'm like, I let it go. When I used to chase these things, that's when I got burnt. That's usually where the problems are. So I look at these leading companies like a Facebook. What are they doing? These leading companies, you can see right here, we're doing the same thing as the market right now, which is moving sideways. Amazon, the same thing. You can see we're almost building an A to right here, B to C pattern right here, to where we can have an A to B to C to D pattern. We could get into the 650. So that's possible. Right now we have that support level holding it up, but it could roll over. So anyways, point being is when you look at these things, people pile into these just like looking at a GoPro right here. You look at the weekly, initially right here, the stock opened up, right? Stock opened up. People love this thing because after a few weeks here of consolidation, almost a full month, boom, we exploded. This is what the market's doing right now if you want to compare and contrast. We exploded and we're starting to go higher, higher, higher. You reach a certain top or climax right over here at the very top. So as you get into this level, there's a week of consolidation and then boom, we just roll over. Then you get people buying back some of those things or thinking, okay, well, the move is done. It's a good value, and then you get the next step down. And by the way, if you're not seeing it, this is the ABCD pattern where A is right here, B is over here, C is over here, and there's your D. And now you can see this stock is in the gutter for the last year. So that's the thing. That's what happens with these stocks and companies. Is that, I don't believe or trust any of them. Most of the time, there's very few people I even listen to on TV or anything like that. So, you look at these stocks, I don't care if they sell underwear, I don't care if they sell umbrellas. It all comes down to that price action and what people want in the stock. People were piling into these banks. And yeah, right here, okay, so you could buy some right here at this price level. Nothing wrong with that. But by the time it's hitting up here, it's a little euphoric. So take half off because that stock could come back to 20 and nothing be wrong with it. So it can come back to 20 right here and then bounce and nothing be wrong with it. Because if the administration and if these rules and regulations continue to do fine and, deregulate these things, these banks can charge anything they want. It's like the health insurance companies like Humana. Why do you think they run up so much? Because they can charge a fortune for premiums. There's no regulation. So that's ultimately what happens in the stock market. So you get that initial euphoria. Yeah, we can do anything we want. Most people aren't going to have health insurance, but they'll charge a premium for it. So they'll make more money. So as they make more money, their stock price goes higher. As we hit into higher prices over here, you're hitting into the 2015 all-time highs. You reject it because you do some profit taking. We'll see if we get into right here, and then we might bounce again. So we'll see. But that takes time because then you get earnings that come in. You get other factors that start to come in. So all these factors play a huge role. And the same thing as you're looking at investments, Ameritrade right here, as you're looking into getting into investments, the market itself, just like Ameritrade right now, some of them are getting into it due to euphoria. So this is the retail investor. And they're usually the ones that are often late to the party. So the big boys, the way they trade it, and here's what happens in the holiday months, is if you're so tight, we're already in December 22nd, if you're so tight to the next year, and I'll show you a great example right here. This is actually exactly what happened last year. If we're so tight to all-time highs or we bounced off of a certain level, look what happened in January, the major sell-off that we had in profit taking of this year actually. If they're so tight into having good profits, they don't sell the stock because we have less trading days, which means they're able to hold through a few days. All they're trying to do on their big positions, the institutions, which are the ones that move the markets, they're just trying to hold on to those for just a few more days, for just a couple of weeks here that we have left. Because as you have half-day trading and as you have days of closing and trading, vacation days, that all continues to time decay. And if they can wait 2 more weeks, they're paying a lot less on their taxes. So normally here, as you look at it on the tax basis, short term, roughly, let's just say capital gains tax is 40%. Longer term capital gains tax, if they are able to push it through and hold through till January, they could save roughly, let's say 20% by going into long-term capital gains tax. So what is it that they do? Well, they typically will buy puts or sell upside calls on it to counteract the difference. Okay, so that way when you lose or the stock even pulls back, even in December, it offsets that. So their losses are so much smaller even in December if you get a pullback because they have puts and they have selling of the calls simply for the fact of that 20% that they would lose if they sold the stock and took profits is just going to be that much higher. If that doesn't make sense, let's go and look at the chart here and see what happens. So here, if we're looking at a trading panel and platform, and let's just say I'm trading Disney, doesn't matter which stock, again, remember, educational purposes right here, and I bought 500 shares. Okay, so let's just go ahead, put this in and place this order in, and again, this is simulated trading, so no big deal. So now I have Disney right here. Here's my Disney stock. I got the order 500 shares. If I look at the Analyze tab and I look at Disney, here's our profit picture. And if you don't know what a profit picture is, it just tells you the graph of the move within that stock. So here's our Disney price. Here's our current price right there. Here's our zero line. Okay, which means if we're above this, we make money. If we're below this, we lose money. Okay, so this is our amount of money that we make. Okay, so easy to read, right? So this is the stock price over here. So you can see as I move to the right, so if Disney goes to 209, I make $1,907. If Disney goes down to, let's say, 102, I lose $1,689. Okay, so you can see how this profit picture really works is that as that stock price shifts right here, and you can also see it over here, the profit and loss, as I move this dotted line right here. So you can see how that really starts to affect my profit and loss, right? The red tick right here is my current price. So I can reset that, make it a live price. Anyway, point being, now I'm up $45 because Disney went up just since that point. So you can see how it's kind of working out right there in my favor for the time being. Now here's what they do. They don't want to sell it because they've been in these positions for quite some time. So the market will, even if it pulls back, it's going to be minor for the potential of it pulling back in January. I'm not saying it's going to pull back in January. I'm saying they're trying to hold out until January if possible. Okay, so understand that's the big picture for them. Or even for me, if I have long-term holdings, I don't want to sell my stock now. I only have about 10 trading days to go. And then I can get long-term capital gains tax and I make 20% more. So I'm looking at this to see if I can hold out. So what do? They do a couple different things, but I'll show you the 2 simple things that they do. And this is why it plays a trick on your mind that, oh, the market's doing just fine, the market's holding up just fine. So what they can do is they can go into these option spreads on Disney, and let's just say we buy a put, buy a single right here, or even a vertical. You know, typically a vertical I would say is a little better since you don't have the theta decay. But to make conversations simple, we'll just buy a put, and I could say I'll buy 5 puts right here. So that way, what does a put do? Just so in case you're curious, white line is the current line today, green line's at expiration in February. And if I didn't want a lot of time decay and I had additional capital, I could go to March, I could go to April. All right, so here looking at this, you can see that right there. If I go into April, you have a theta decay right here at $7 per day. So if you're only holding it on for 10 days, $70. right? So it's not that expensive compared to if you get a major pullback in stocks, it could be a problem. Now you do have that theta decay, but if the stock goes down, you can see you make about $500 if it goes down to 101, 102, but you do have to compensate for that time value. So if I move the day just till December 31st right here, so you can see the theoretical day, and if it doesn't move and the price is right there, I lose about $70, right? 10 times 7, $70. But if it does go down right here, at least I could potentially, for a catastrophic event, be over here and at least make $200-300, which, you know, is not big money, but it helps compensate these 500 shares that I have. So here, let's say the stock goes down to 100 and we tank, okay, I would lose $2,616, but on holding my puts, okay, right here, I would make $100 at the $100 strike price. I make $700, okay? So between both of these, if you combine it, this is what the profit picture will look like. So if I had the puts right here, I would lose $18.55 at 100, right? So it pulls back $5. I would lose $18.55. Whereas over here, if I didn't have the puts, I'd lose $2,677. I hope that makes sense because, you know, the $1,000 loss, you're basically losing now less money by $1,000, pretty much, give or take. But think about it, if I got rid of the stock, I would have to pay an extra 20% more for the tax implications. So this is one of the things that they do is they try and hold on for another 10 days here and just get through it so that way they don't have tax consequences. And then if they see it rolling over, boom, they can be out. Now, things could accelerate here still. If things do accelerate in a big way, then of course they would get out of the positions. But buying some puts is one way to counteract that. The other way that they counteract that is they go ahead and you could sell upside calls. So if I sold an upside call, okay, sell a single, analyze, and what this does is it gives me kind of, again, the same thing, a downward direction bias just on that single call. And if I go to, again, let's just say, maybe I would do March here, because now I'm actually looking for time decay. So I make $1 a day, but if it also goes down here, I have the deltas to counteract that. So I have 13 deltas. So what I could do is just sell, let's say, 5 of these right here, because I have 500 shares. Each contract is 100. So I could sell 5 of these right here. And now that stock could go to about 115, and I still would collect the premium for this. But I can also make $310 if this expires in, March, and it's under 115. But if it gets to 100, I make $250. Now, I could do the February, even the January ones, but the premium is not there. So you can see the premium in January is only $5 to go to the 115s. So maybe the Februaries, I could do those, or even the Marches. So it just comes down to the premium. But here, if I did the Marches, you can see now, pulling back to 100, I make $252. Not as much as buying the puts, right? Not as much as buying the puts, but here you can also allow this to expire in March and collect the $310. So it's a different way of playing it. So when you look at it this way, you can see your profits on the upside are still capped. Okay, so once it gets to 120, you only make $5,195 since you're selling calls, because your stock could be taken away if it gets beyond that 115 strike price. So here, if it pulls back, you know, to, again, let's just say 100, you're going to lose 2,360, whereas without those, you'd lose $2,613, because again, the $200 that you're making from those selling the calls. So it's not a full $700-800 like buying the puts, because when you buy the puts, you have much more delta in them when you're buying those puts, depending on where you buy them. But you can see what's happening is I'm still counteracting for the downside move. So again, the big point and the big picture of why the big money managers do this is to offset that 20% of capital gains tax that they could save. Okay, because if they went ahead and just sold this stock right now, they would pay an extra 20%, give or take, depending on their tax situation. But in either case, roughly, let's just say 20% more in capital gains tax because they're paying the short-term capital gains tax. So that's what they're doing. And this is why the market, especially right around this time, in December, you might see a little pullback. They might take some profits to reduce the risk, but they don't want to do it too much because the problem is if they take a lot of profits, they'll tank this market, and then they also will be forced to get out of the position and then to get short-term capital gains tax and, get out of their positions to lock in their profits. So it hurts their bottom line and budget. So what they can do is, as long as they can keep it propped up for a little bit or hold on to that position for about 10 more days, which a few of those days, as you know, are holiday days, then eventually they lock in an extra 20% and, they still are in that position. And then come January time, just like if you look right over here, what happened in January, right here, look at what happened in January. Pretty good sell-off, right? Now, I'm not saying this is going to happen this time, but they try to wait for that because of that 20%. And if you look again, right here in January, this was small and subtle, but you can see again in January what kind of happened, right, in 2015. I don't know what's 2014 was a very bullish time frame, but you could kind of say, okay, well, this little bit January, February, maybe it's a small little pullback. Again, you have to do your own evaluation of this. But looking at 2013, as we got into 2013, this was right before the January time. In January, we actually broke out because all the profit taking was in October, which was probably earnings, October, JAJO, right? October, right there. And that was our profit taking. And then come January, they bought more out because of the value. So again, things to consider. But remember, this is why sometimes when the market's acting a little choppy right here, especially on this with 10, 15 trading days remaining as we get into January, you're probably not going to see a major pullback before then because they really want to prop it up in order to get the extra 20% on their capital gains tax. They're looking to save that additional money. It's just expensive for them to sell it. And especially when you're dealing with millions or billions of dollars, 20% is a large amount when it comes to their pocketbooks. So that's what they try to do is they try to hold on to this, move it sideways, just kind of wait for time to expire. And this is what's going to happen. It's probably going to be slow up until the end of the year. We'll see if you get some panic motions and panic attacks, something just happens, boom, you might see it sell off in a big way. But I don't think you're going to get that right now in this month. Right now, it's acting slow. We are getting a couple of red days simply from the expansion to this upside. But otherwise, it's just looking like it's sideways digestion. So in either case, thanks for joining me in this video. Don't forget about the live classes in the schedule right now. Even if you're a regular Critical Charts member, you could sign up for that. Again, it's absolutely free for those Critical Chart members right now. As we come out next week with the video packages, you'll be able to register for that. It'll be, again, an additional charge, but we're doing it at a discounted rate since I have people that have been with me for years, and that's just my way to contribute. So we'll do those at a discount. If you're interested in the Accelerate Your Stock Market Education course, then go ahead and take a look at that course because, the old course, if you buy the old course, you'll also get this new course with it, and you'll get it obviously at the old course price. So go for it. If you're interested in getting yourself a course here for the holidays, I would say that's the way to go. That's the newest course that I have available coming out. But you will see all these new videos that come with it within about 2 weeks. They're already filmed. We're just adding in the sales page and tweaking a couple things, and then it'll be good to go. All right, so thanks for joining me in this week's lesson of Let's Talk Stocks. I hope you enjoy the holidays here this season. So thanks again. If you want to continue watching some of the other training videos that I have, click the thumbnail right over here. But if you want to sign up to that newsletter list so that way you know where to register for those live classes, then click the button over on this side, enter your name and email address, and you'll get those newsletters as they are released. In the end, remember, there's more to life than money. Go out, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.